what most people are missing today is you're never going to get rich or wealthy if you just trade hours for dollars. The only way to get wealthy and stay wealthy is to understand how to make your dollars work for you.
And welcome to the 0 to 100 podcast. I'm Travis Dillard, and with me is my trusted sidekick, my number 2, Gabe Hamill, or number 1, I guess.
Thanks, buddy.
Yeah, and Mitch is out frolicking around the country in an RV, so you just get us. But I will tell you, man, I'm excited about our guest today. We got Chris Naugle. Chris Naugle is one of those guys, by the way, as I was reading his bio and watching his YouTube video. If you feel good about yourself and you want to just knock yourself down a few rungs, just listen to what this guy's up to. I'm joking, but he's a badass, man. He's the founder and CEO of the Money School and the Private Money Club. Chris teaches you to be your own bank, which helps you solve your money problems by putting you back in control of your own money. I was also watching, Chris, your YouTube channel about your story, which is super cool. Snowboarding, opening up a shop at 17, mom leveraging the house. I want to dive into infinite banking and all the things. Welcome to the show, man. Where are you calling in from today?
From Buffalo, New York, and thanks for having me on the show.
Absolutely. We're excited to have you here. Let's get into your backstory a little bit. So snowboarding to money school. I mean, there's got to be a lot of things in between. So let's kind of start with little Chris, like childhood. What were you doing before you got into snowboarding and started learning about money?
Yeah, so grew up just in a lower middle class family, raised by mom. Dad was an alcoholic when I grew up. And listen, back when I was a kid, we had like 2 acres of land, and I would just go in the backyard. I'd build BMX tracks, jumps for the dirt bike, and then I always had a mini ramp or a 4-foot vert ramp back in those days in the backyard. So I was just a little skateboarding kid. And snowboarding was an interesting thing because I never even knew about snowboarding. I was just skateboarding and BMX and that stuff. But my friend Jack brings a board over one day and it had bindings on it. I'm like, what is this? We're bouncing around out in the garage on it. And he's like, it's a snowboard. It's like skateboarding and surfing on the snow. I'm like, well, yeah. I mean, Buffalo, New York, we get a little bit of snow here. So that was like my intro into it. Snowboarding was kind of my gateway into just becoming who I am today. I mean, it just allowed me to just be free, do the things I wanted to do. I just didn't have money to go to the resort. So a lot of the kids that I grew up with, they would go out to the resorts. But I was lucky because by the school I went to, there was a country club. It was called the Lockport Country Club, and it was in a ravine. So how I learned every trick is I'd watch VHS tapes of the pros, and then after school, mom would drop me off at the country club, and I would build in the sand traps. I would build jumps coming out of the sand trap. So I'd start at the top of the ravine, I'd drop in through the sand trap, hit the jump, and then I had a natural landing. And I swear, almost every trick I learned was learned at that country club until I got to be around 16 years old when I had a car and I could go to the resort and I could actually afford to buy a season pass. But that's like little Chris. I was just a little punk skateboard kid. And the one thing that happened that launched me into being an entrepreneur was when I was 16, yet I'd always worked from 14 on at a farm, my friend Jack's dad's farm. But at 16, I got a job at a restaurant. And the owner of this restaurant treated me so poorly that I was probably clinically depressed. I mean, I couldn't do anything right by this guy's mind. So one day I quit, but my mom, I couldn't come home and disappoint mom. That was like my number one objective. So I had this whole idea to create this clothing line called Fat Clothing Company, PHAT. And I was going to print shirts with my art teacher, Mr. Mahalski, after school and sell them out of my backpack. So when I quit that job at that Italian restaurant, I came home and I told mom I quit. I was super bummed out and upset about it. But I said, Mom, but I got a plan. I'm going to create this clothing line called Fat Clothing Company. I'm going to print shirts with Mr. Mahalski. I'm going to sell them to all my friends. And that's how I'm going to afford all this stuff. And mom was just like, go for it. So that was I was 16. It was 1992. I'm dating myself a little bit here. And I did exactly that. Sold my clothes, and I started designing clothes, and I hired seamstresses, and I had like a couple sales reps around the country that were selling my clothes to shops, even in Portland, Oregon. I had heard you guys mention, Oregon out there, and I know that just because of Mount Hood. But that was my first business. And I remember I was on a snowboarding trip And I stopped at this one shop called Hard Packed, and the guy, Tim, who owned it, I was selling him my clothes, and he like right after we were done doing the little pitch, if you will, the sales presentation, he says to me, he says, "Hey, Chris, you want to go snowboarding?" Now, it was just me and him in the shop. It was mid-afternoon, and I kind of look around. I'm like, "Yeah, when do you want to go?" I'm thinking, crap, I got to get home because it's 2 hours from home. And he's like, "Let's go right now." And I was so confused because I'm like, okay, we're the only ones here. And I said to him, I said, "Do you have someone coming in? Like, what are you going to do?" And he said, "No, I'm just going to close the shop. I own it. I can close it." That was it. That's all I needed to hear. I'm thinking to myself, this guy has so much control that he can just shut the door and go snowboarding. And we did. But from that point on, all I could think about is I need my own shop. So I spent the next year just planning out a shop called Fat Man, P-H-A-T again, Fat Man Board Shops. And lo and behold, that shop opened November of 1994 in the Lockport Mall. My mom, who was my unconditional one, put her house up on the line. And just so you all know, we lived in a 700 square foot ranch in Lockport, New York. This is the only asset my mom had because it's what she got in the divorce. So she put this house on the line so that I could chase my dream. And, I will forever be grateful for my mom and, she's my hero, but that's how I got started. No secret. Mom put her house on the line. So I owe it all to her. And that shop, kind of funny story, I'm going to pace way forward. I went on to be a pro snowboarder and I ran those shops, had multiple locations. We'll transition into the money in a second, but I sold that store in 2018 when we got our show on HGTV, the flipping show called Risky Builders. And I'll never forget, like when I sold it, I thought there's no way they're going to make it. Well, that store is still open today, literally. So like talk about a legacy from 1994 to 2025 and it's still kicking butt.
Wow, good mom. My mom wouldn't even buy me brakes for my piece of shit truck. So yeah, you got a good one. Almost killed him.
I had one good one in my life. Yes.
Yeah, I'm just joking.
Yeah, Chris, when I hear your story, something that really stands out is, sometimes entrepreneurs they're attracted to the money. Other times it's something else. It's just that drive. But it sounds like you were attracted to the freedom. And we're real estate investors, and we talk a lot about financial freedom, but also the time freedom piece. And so I love that in your story, you say, hey, you were at this shop and you saw the willingness. This guy could just close his doors and go hit the mountain. And so like when I hear that, I think like, okay, you understood there was a freedom to this, being your own boss, not working for someone else. I mean, you had an asshole boss at the Italian restaurant that really he dictated, probably what you did and where you had to be and what you had to do. And then you meet this other guy that can close his doors midday and say, hey, let's go hit the mountain. And so the freedom piece of that sounds like it was very attractive to you at a pretty young age.
It was. I mean, my number one was snowboarding, right? That's the only thing I cared about is snowboarding. And in the summer, I would surf. That was pretty much it. And then skateboarding on free time. So freedom of time was everything. I couldn't be locked into a job that dictated where I had to be, when I had to be there. I needed that freedom. And having the shop, I had my buddies working there. So literally, I can't even count how many times I would literally call up Randy, who was the manager. Like, Randy, hey, you looking for some extra hours? The surf's up, because I used to surf the Great Lakes quite a bit. I'm like, surf's up, would you like to take my shift and then I'll trade for your evening shift? So he'd come in at 10 in the morning and work till 4. I'd go surf and then I'd be back and I would just flip flop and I'd work the 4 to 9. And I did this all the time.
You're saying that you were in your teens when you owned this first shop, right? Your late teens. Are you still in school at this point? Or are you just like, bye school, I'm an entrepreneur. I don't want to learn about the Bronze Age, which isn't going to do shit for me, or social studies. Like, I'm going to go learn how to, run a profit and loss statement. I mean, is that it? Or were you still in school, like limping along while you're building your empire?
Yeah. I mean, listen, like I will never stop learning. I'm always learning. And back then, yeah, I was in school then, but you see, I don't have a ton of schooling. Like I've got lots of accolades, lots of things behind my name, but I really I went through high school and then I did 2 years of college back then. But here's the big difference. even in my junior and senior year of high school wasn't for me what it was for all the other kids. For them, it was just graduate and go on to college. For me, I got to know the teachers like Mr. Crawley, my accounting teacher. And then I had a business law teacher, and anything that was around business, they took me under their wings. They became my early mentors that like showed me how to do debits and credits and, business law, how to stay on the right track for that. So when I went to college, I went to a community college back then, and all I did in college is took business classes. But I wasn't just learning to pass. I was learning to literally come home from college and apply it in my business and do it over and over. Listen, so that's way back then. I mean, I'm 18, 19 years old at this point. Fast forward to today. Yesterday was my 48th birthday, and I still do the same thing. I am continuously and forever learning.
Happy birthday, by the way. And
thanks,
Travis
guys.
is similar age, but God, Travis looks so much older. It's
Oh, would you
so
stop?
much older.
He looks way younger than I do. I'm staring at the same Travis you are.
No,
I'm just kidding.
No, I think we're
kidding.
both handsome, Chris. I think we're legends again in our own mind. It's funny that you mentioned that about the teacher networking with your teachers. It was a unique conversation I was just having, and I had it with my nephew who's 18, who's going off to college. He's going to major in entrepreneurship and I think a minor in sales. I'm like, perfect. If you're going to go to college, learn how to run a profit and loss statement, learn how to build a business, learn sales, by the way. I mean, I think people underestimate how important learning to sell is. And it is, in my mind, it's a learned trait. And you're selling to investors, you're selling to customers, you're selling to vendors, you're selling to bankers, you're selling to your mom. You're always selling. But the conversation, and it's funny because my buddy was with me and his girlfriend is a college professor. And I was giving advice on, he wants to build a business, he wants to invest in real estate and scale a portfolio like we do. And she had really interesting advice. She goes, when you're in school, build a relationship with your professors, because these are people that have probably started businesses, they've operated businesses. They're probably, if it's the right program, and they're not, a lot of professors are professors because they couldn't make it in the real world, but not always, especially in the entrepreneurship programs where these are people that actually aren't there for the paycheck. They're there because they want to pour into these kids and these students. And she said, don't just go to class to get a grade. Network with these teachers. They will gladly take you under their wing. They'll introduce you to other people, maybe in their sphere of influence that can help you. They're going to give you advice. They're going to because they're going to want to pour into you, because people that are successful, and I'm sure all three of us, we always want to pour into people and help people out. So that's good advice for young people that are listening. If you're going to go network with your teachers. And I think that's your first networking lesson right there.
Yeah, and you mentioned something else that I think is vital, and I got to ask both of you guys. So when I was in school, and I don't remember how old I was, but I used to go to the store with mom, and I would buy the bulk Jolly Ranchers or whatever they were, the candies. I would bring them to school and I would sell them for a markup, a quarter when I paid in dime. You guys did that, right?
I literally did that, except for I didn't get lunch money, but my buddy Adam got lunch money. And so we would meet at the store. I convinced him to buy the candy. This was 6th grade. He would buy the candy, but it was my idea. And then we sold it out of our locker, which was crazy because this was the only middle school that actually you could go off campus at lunch, but kids were still too lazy to go across the street. So we would sell the candy and split the profit 50-50 out of our locker. And then I did the same thing with condoms in 9th grade, but the school shut that down pretty quick. So
hey man, love it.
I love it.
I never did that. I learned something new every day. Gabe was selling condoms to other kids in the 9th grade. That's, it's whatever works. It's funny when we interview people on this show and talk to people that are successful, there is a common thread. There's go to Costco, buy in bulk, put them in separate baggies, mark up, sell. There's paper routes, and then growing your paper out and hiring your buddies, those sorts of things. So I think we're all just a little sick in the head. We're all just kind of wired weird.
Yeah, you mentioned sales. Sales is the greatest profession on earth, the highest paid profession on earth. And, the funny thing is all of us, and I kind of knew you guys did that. I didn't know, but I knew because it's sales 101. And it's kind of you look at kids now, and I'm sure they still do this, different things, but that is the greatest teacher any kid can ever had. And then we go to the teachers, and then you find a teacher that condones that, or you tell a teacher and they become your mentor. Teachers were, to me, the best mentors. And I want to go one other thing. I had a teacher, his name, Mr. Nemi, his name was, in college. And remember, this is a community college, and he was a business owner. He's the one, So I give my mom all the credit for Fat Man being open because she's the reason I was able to get the financing to do it. Mr. Nemi spent months upon months with me, helping me write my business plan. Because I remember I went to the first bank and I pitched this idea and they're like, hey, do you have a business plan? And I'm like, what? A business what? So like he helped me write the business plan and went through a bunch of iterations. I learned about projections and marketing plans and all this. And like, you got to remember, I'm like, at that time, I'm 17 years old. I had no idea what any of that was. But I will say, back to those Jolly Rancher days, I knew how to sell. And I knew that once I figured this stuff out, I was going to be able to sell whatever was in that shop.
Gabe, did you have your teachers help you write a business plan to sell condoms in high school?
No.
You're on your own there.
You should have, man. That's the missed opportunity.
Yeah,
real estate.
Yeah, I might have to
you had something going with
revisit this. I might have to revisit this. Well, Chris, let's get a little more into your story because you didn't stop there. I mean, you snowboarded professionally. I can get a TV show. Is that right? You're flipping houses?
Yeah, that was a little after. Let me just kind of bridge the gap here because there's a huge gap in between. Well, the stores are going great. I was living the dream, traveling the world on somebody else's nickel, snowboarding in what I would say was probably the second greatest generation of snowboarders ever to exist. But what happened is we had kept opening multiple stores for Fat Man. So I had 3 locations by that point. We just opened one in a little ski town. It was like a boutique and it was an expensive store, but it required me to leverage myself heavily, like go deeply in debt. And I went out to California for a trade show and I flew home. I'm driving to this new store. Just folks listening, just like think about this. And on my radio, back then we just had regular radios, none of this stuff like today. Turn it on and I heard about a plane crashing into a tower in New York City and then another one. And you all know now that was 9/11, but like it was surreal at the moment. I thought it was just like a little plane that kind of miscalculated and hit a tower, but then the second one hit. So after 9/11, one other really important thing, because it brings me right to today. I had no idea what a recession was. Okay, I'm just this kid snowboarding, living the dream, owning skateboard, snowboard shops. But after that, the dot-com recession kicked in. It was a 3-year-long recession. I'm heavily in debt. Business literally just halted. We were down 30% the first year of that recession. The second year, it was about the same. I couldn't make my bills. I couldn't even afford the lease payment on my truck. And folks, we're going way back. I mean, my truck, I had like a ZR2 S10 was $199 a month and I couldn't afford it. So I needed a job. This is the first time in my life where I'm going back to like those days where I needed a job. I was self-employed up to this point and just, by my own way, successful in my right mind. But I wasn't, remember having the shops and snowboarding wasn't about becoming wealthy and rich. It was just about freedom. It was about traveling the world and doing what I wanted when I wanted to do it. And it was the greatest thing ever. I'm going to tell you guys, I miss that more than anything else. I have lots of money today, but I don't have the freedom that I had back then. And every day of my life, I miss that. But this recession forced that away from me. I needed a job. I put my resume out. My resume fit on one page. Community college, business owner, period. End of story. The only people that got back to me, I even got turned down at Little Caesars Pizza, wouldn't hire me. But the people that responded was Wall Street firms. I knew nothing about Wall Street, knew nothing about stocks. And I remember my first interview, grandma took me to this store to get me a suit with a zip-up tie. I didn't know how to do a tie, a zip-up tie. So I went to the interview and I got the job. And that's where I made the transition. And, honestly, at first I was so scared. Like I was so bad. So I'm a huge Volcom fan. Like a lot of my stuff was modeled after that company. And maybe you guys know it, maybe you don't, but very revolutionary company back in the day. And I could not get over the mental roadblock of putting a suit on every day. I had to wear a black, a gray, or a navy blue suit every single day at this firm. And only way I could bridge the gap from my snowboarder to now this Wall Street guy was to buy Volcom suits. And Volcom, for like some other athletes, had just started making suits. And because I sold their brand, I got them to give me a couple suits in gray, blue, and black. And the reason I say this, folks, and to you guys is mindset is so powerful. It can literally crush you or it can make you. And whatever it is you got to hang on to, whatever that one little vice is that gets you over that mindset shift, you need to hold on to it. And for me, it was just having a commonality with snowboarding, and it was that Volcom suit. So Wall Street basically was the most interesting thing. I was really good at it. And I rose to the top. I became one of the top 3 advisors. My first year, I made 74 grand, more money than I'd ever made in anything else.
Sorry to interrupt, but where are your stores at now? Did you have to shut those down because of the economy? Because I started my first business in 2001, like a few months before that. It was a tech business, and it kicked the shit out of me as well. It was really, really tough. And we limped along for another year or so, and then I had to basically shut it down. I'm curious, are you still running these things, or are you like shut them down, focusing on Wall Street now?
No, so I'm still running the shops. And this is really the most unique, most amazing thing that happened. I closed that Orchard Park store. I rolled up all the inventory into one of the other 2 stores, or the other 2 stores that I had. But because I was now working like literally 8 in the morning till 6 at night in Wall Street, I was only in the shops at night. But what it forced me to do, and this is something most entrepreneurs never ever get to the point of doing, is it forced me to work on the business, not in the business. Up to that point, I was in the store every single day. There was nobody that could grip a skateboard better. There was nobody that could put a snowboard better together than me. Like that was my mindset. But once I was in this job, I couldn't do it. So I had to put people in charge, had to put managers in place, and I had to start working on the business. And that's when my business was suffering during that period because of the recession, but we didn't close and cut expenses, got rid of that location, stabilized, and then things started moving up. But they literally, after we got out of that rut, they started climbing to new highs. And I wasn't even working in the shop. And this was a real revolution, or revelation to me, I guess is the word I'm looking for, where I'm working on things like putting together events, putting together a skateboard team, a snowboard team, putting together events and skateboard events and snowboard events, and working on the business. And because of that, we became like iconic in the area for like the core snowboard skateboard shop. And that's why our business took off. All the while I'm in Wall Street working, making great money, pouring that money back into the shops to do more, advertise more. It was the greatest thing ever. And that's how the 2 existed. I had to disconnect myself from the store, from working in my shops, to now work on them. And I started this is when I really took a liking to QuickBooks. Was a newer, I don't know if it was new then, but it was a newer thing back then. And I got really good at QuickBooks. I got really good at reading reports because all the guys would give me reports, and that's how I ran the business. And I did that, continued on all the way up till I sold the shops in 2018. That's how I ran them. And I maintained that financial advisor position from 2003 until 2018. And I still was snowboarding in there too, because even in the financial advisory role, I still had freedom of time because yes, I had to go into the office, but I didn't care if you were there or not. If you were putting up sales, if you were selling and hitting your numbers and building the client book, then they didn't care what you did. So I still maintained freedom of time, but now I'm making real money, like 6-figure money. And I still had my shops. It was a pretty interesting time.
It's interesting that you mentioned that, to tie it back to real estate. We talk about, they buy an apartment complex, let's say. Then they manage that complex and they're in it and they're mowing the lawn and running applications and they're talking to tenants. And I think, and same with a business. When I started my first business, I was project managing. I was out climbing under desks, installing IP phones. I was doing all these things. Then when you're forced to disconnect, like you're forced to hire, like let's say you're literally thrown on the other side of the country. You can't touch that business physically. You're forced to then start working on the business. You're forced to start putting the right people in place. You're forced to sort of get out of the email and the monotony of the day and really focus on putting systems in place and being strategic. And so I love that you said that, tying it back to real estate. People we really started taking off when we bought our first property 3,000 miles away because we were forced to hire the management team, put the systems in place. So I just wanted to, this is a business conversation, but I did want to tie it back to real estate. And I did love that you used that example because it's like, what is it? The one thing where you're forced to, like, if you could only do one thing today, like, what is it you're going to do? And it really forces you to focus on the things that are going to move the needle the furthest.
It definitely does. And let me bring it to real estate really quick since we're on the topic. Real estate came to me in 2006, and it came to me because I had a client, a very wealthy client, like one of my wealthiest clients, but the dude would give me no money to manage. I'd ask him and he gave me like some money to put into a SEP IRA because he needed deductions, and that was it. But I knew how much he had because he told me, and I knew he was in real estate, but I remember him telling me, he said, "Hey, listen, like I know you're into all the stocks and that." He said, "But you should start buying real estate now." So I did. 2006, I did my first flip. It was a stumbling way through, like all of us, but I ended up selling that. I thought I was going to make 40 grand, made 8, but hey, listen, made a profit. And then 2007, did another one. 2008, I bought a dilapidated paint store. My lease was coming due in my main Fat Man shop. 2 buildings down was this dilapidated garbage place, but I had this dream that I'm going to buy it and I could get it at a discount and I'm going to convert it into a 3-unit strip mall. So I had done preliminary planning and I found out I can fit 3 units in it, my store plus 2 others. So I started thinking, all right, when my lease is due, I'm just going to move into this new shop. Now, that all sounds great, right? I did this in 2007 is when I started the process. I closed on the building in 2008. Early 2008, and I started work on the building in 2008. You know where we're going, right, guys? The Great Recession. It's like getting hit by a Mack truck. This was a hard money loan, 15% interest. Everything was great when Wall Street's paying me and when my shops are performing, but that Christmas, my business in the store, Christmas was like 80% of your money you made for the year for profits. We were down 40% that first year in 2008. I couldn't make my bills. I went through all my savings, took all the money out of my 401k, maxed out loans on all my life insurance policies just to make payments to these guys. And I got down to, I had 2 months of payments left. I had just moved this really hot girl in my house as like, just like everything's going perfect. And I had to sit her down about 2 months into the relationship. And I said, "Sweetie, I need your help. I need your help paying the mortgage. I need your help paying the utilities. And by the way, my friend Pete and my friend Jessica are both going to move into the 2 empty bedrooms in our house. Any questions?" As if like this was just like, she was just supposed to say, yeah, I probably had about, and if there's any women listening, they're like, this dude had no shot of keeping her. And you're right. I probably had less than a 5% shot, but she did. She's now my wife. We've been married for almost 18 years now. We got a 5-year-old, but Larissa was the one that did that. And that's the only way I made it through 2008 without going bankrupt.
I love the story because there's a lot of younger people. Gabe's younger than us, but he's still in his 40s. There's so many young people that
Am I, Travis?
You are. I mean, you don't look younger, but you are physically younger. Yeah. But yeah, I mean, there's a lot of young people that crushed it through the run up. When the tide's up, everybody's crushing it. Everybody's making money. Everybody looks like geniuses online, especially. And I love talking to people my age because I started a tech company right before 9/11. I got kicked in the nuts by that, right? I had an alcoholic business partner that ran us into the ground. I started doing spec houses before '08. I got my teeth kicked in again, right? Like, and we just keep going and you start another business and you keep buying real estate, and I do love that because I think people need to listen to this and realize, well, I think people are starting to realize that now. There was like a lot of apartment syndicators, especially that were raising capital, buying apartment buildings. The values just kept going up. Everything looked great. And I kept thinking to myself, like, dude, I've seen this twice before. Like, everything's cyclical and here we are again. Interest rates are high. I think inflation's high. It's not as ball crushing as like 2008, but it's tough, especially in real estate right now.
I don't think it's started yet. I mean, being where I'm at now, I can't call myself an economist, but I study it like a nerd. I read everything you can about cycles and economic conditions. Oh, we can get into that for sure. You might not like it, but I think multifamily, since we're talking multifamily, and that's where my story's going next, because after '08, I regrouped and I literally put everything I could together, but I was reading Warren Buffett's books. I was reading them like they were going out of style. And I remember buy low, sell high is all he said. And in 2009, like everything was on sale. So I found this realtor, Anas, and she started showing me these apartment buildings and I started buying them one after the other. I was building that leverage thing up again, but I got up to 36 units from 2009 to 2014. On the weekends, I was going to the buildings and I was doing work on them. I was mowing lawns. So I was kind of like learning. I was flying the plane. We're taking off as I'm still putting parts on the plane on. Is basically the way what I'm trying to say is I was learning it the hard way. I didn't really have any family members in real estate. I didn't do any coaching, no mentors, nothing. I just was like, real estate's a good investment. It's cheap. I'm going to get in. Let me stop right there. Let me kind of transition over to what we were just talking about with the recession, which we'll get into. So you and I have been through 2 economic recessions, 2 verified recessions. Now, if we look at younger folks, because I'm 48, let's just go down to 38. Gabe, how old are you?
I'm 43.
So you remember 2008.
Absolutely. And I think we had a very similar timeline in terms of the real estate. Now, I wasn't a professional snowboarder, but really, I bought my first home in 2005, again in 2006, again in 2007. And then 2009, I started really buying and built my portfolio. My initial portfolio, 2009 through 2013, all no money down seller financing.
Wow. You were doing that back then?
I was doing that back then, and I saw that as an opportunity.
Way ahead of the
curve.
So
a lot of the people in my, were like, this is risky. Prices are going down. And I'm like, this thing cash flows. Like my only focus, my only criteria back then was it had to be cash flow positive. And so our listeners, they know my story, but I became financially free when I was $1,500, less than $1,500 a month cash flow positive, but I had that freedom and it gave me the time to go put more and more deals together. The focus was really just buy and hold cash flow real estate. But I saw that as an opportunity. I watched people get their ass kicked in 2008 because they were speculating. They were buying low, trying to sell high, and that worked until it didn't, or speculating on rents going up forever until it didn't. But, 2009 through 2013 was an amazing time. And if you were willing to take that opportunity.
Did you maintain, were you able to hold those proproperties through that whole cycle, through 2009?
Every one of them. Yeah.
That's where we are very different. And I think that's an interesting thing. But let me just finish that other thing about the economy. So like if anyone's 38 years old or younger, they have not felt the impacts of a recession like we have. They literally don't know the downside to the upside, right? The risk is there now. They're seeing it. Maybe they're getting pinched, especially multifamily syndications, a lot of pinching going on there. But most investors today that are younger than us, they don't know the downside. They don't know the real downside like we do. And I think the sad part of the whole story is they're about to. Believe it, don't believe it, I don't care. It's coming. There's no other way around it. The Fed's not going to save you. The government's not going to save you. It's just a cycle. And this is the longest one in verifiable history. But anyway, back to when I lost them all. I got up to 36 units. And in 14, I'll never forget this. I found this really good duplex. No big deal. Took it to the same bank that had got me out of that hard money loan with the Plaza. The reason I didn't go bankrupt is this bank, First Niagara Bank, and this guy, Greg, helped me get out of that. So I did all my mortgages through this guy and through this bank. In 2014, took my 37th door to the same guy, the same bank, thinking this is a slam dunk. I'm just going to add this on. And they asked me the questions, and he came back and he says, we can't give you the mortgage. I'm like, Greg, why? He's like, your debt to income ratio is out of whack, essentially is what he said. Meaning for the income, and I had great income because I was the advisor. I had a couple income streams, all the rentals. And, my debt was what I thought was low, but the way they counted it, because here's the mistake I made. So I want your audience to really hear this. I was going with personal mortgages in my personal name. I had an entity, but I wasn't doing the mortgages in my entity's name because, well, number one, the interest rate was higher and you couldn't get a 30-year AM. So you could get like 20 or 25 and the rate was like a point higher than what I was getting them for. So I just did them in my name. Well, if you study how that works, you're going to get to a certain level and you're going to hit the financial wall. Well, I hit that wall at unit number 37, which is pretty high for hitting the wall. And they wouldn't give me that mortgage, but it got even worse. So now I'm like the bad guy to the bank because I didn't fit their little box. So I had 2 lines of credit with that bank that I used to literally do all the renovations on these units. They froze both of them. And it happened like this. He said, no. Next thing I knew, I got a letter on one. Next thing I got a letter on the other. Froze. So if any of you think that your line of credit is untouchable, that the bank can't freeze it, I got news for you. They certainly can, and they will.
I swiped my line of credit right before and used it to start my tech company. And right when I did that, they froze it because they realized my house was upside down. It was a line of credit against the equity of my home.
I think this is actually a great warning for younger investors because I've heard people talk about their liquidity being lines of credit. And I was fortunate that I didn't use lines of credit, but in 2012, when I went to my first paid real estate event, I had met a lot of investors that got their ass kicked in '08. And a lot of them, the same exact story. Yes, they were banking on appreciation. They were banking on prices going up forever, but a lot of their lines of credit got completely frozen and that was their liquidity. And then 2008 rolls around and by 2009, they don't have access to any of that capital. And just like you're saying, they just turned it off. Like it was just gone. It wasn't available anymore.
I never thought we'd get into this stuff in this podcast, but like how valuable is what we just said to everybody that's listening to this podcast? Like these are things that people think that they don't think they can happen. But you just heard 3 people and actually 4 people talking about this happens, folks.
You think your banker's your friend, you're patting each other on the back, you're holding hands, you're skipping off into the sunset, and then he pushes you off a cliff. When shit gets a little weird, banks are just like, nah.
Well, and these weren't just this event I went to in 2012. It wasn't just small players. I mean, Ken McElroy was there, who we just had on the podcast. Kiyosaki was there. Like, these were some pretty big players in the real estate world that were like, yeah, these lines of credit were gone. Like, overnight, they just turned them off. They weren't there anymore. And we are coming through a cycle where money was easy and cheap, and now it's not. And so I'm already seeing some of these multifamily investors getting their ass kicked. And it's, it'll be interesting to see. We've talked a lot on here about what will the banks do, and are they going to take these properties back? They don't want them on their books. But at the same time, like, some investors that were buying on slim margins and are in a pretty tough spot. And I think also it's about to be a little rougher for some of these investors.
It's going to get a lot rougher. You're already starting to see it. If we have time today, I'll get into some of the stats that'll kind of wake people up a little bit. But for everybody listening, for both of you, like, just because you held your properties, but 2009 to 2014, like, arguably, like, the greatest period of time in our lifespans to buy real estate. Like, you owned it, and I just couldn't hang on to it. It was like I had it, but I couldn't hold it. It was too good to hang on to, and I had to sell it all. And that's when me and my wife, we started flipping houses, because those were all holds. Those were all apartment complexes that I owned during that time. So the next cycle was the flipping cycle, because I knew I could get in and get out and get in and get out versus holding on to it and trying to maintain it. Those lines of credit were so vital for me, because, like, I just didn't have I had high vacancy because I was buying so many units in a short period of time that on my own weekends and with the dollars I had from income, I was renovating units. So I had a lot of units mid-construction when that all happened, and that's why I couldn't keep them.
Did you have to sell those because you didn't have positive cash flow on them, and so you eventually go negative, or did you not have the liquidity to float those? Or
it was kind of both, because remember, we're just coming out of 2008. That's why I always preface that I went almost bankrupt in 2008. I exhausted everything. Everything was leveraged. Everything was gone. So now I built up from nothing. So I was fully relying on the banks. I mean, listen, like, there's no secret. Like you mentioned it earlier, like, what I do today is I teach people how to be the bank, where you don't need to rely on banks, how to be in control of your money. There's a reason for that. And that's what I'm telling with the story is, like, the bank, my buddy Greg, totally pushed me off the cliff. And I don't even want to think of what that would have been worth today. Yeah, scumbags. Now, let me pivot there, because I don't want to get into the flipping quite yet. Let's go back to some of the things happening today. I've been on probably 500, 600 podcasts, and I've kind of been on a lot of them where they've called my bluff years ago, where I was like, hey, real estate, I know there's a ton of demand. There's a huge need for housing, which we can't disagree. But I kept saying, like, you guys aren't even looking at the risks. And I would get shunned on some of the multifamily shows. But here's what's been going on. Like, yes, there's a huge need for housing, but for some reason in the last, let's just say 6 years, all the developers and the real estate investors completely ignored what real estate there was a need for. So after COVID, everybody had money. There was $5.2 trillion printed. So everybody felt flushed. During COVID, people saved money and paid down debt for, like, one of the first times in a long, long period of time that actually happened. So we came out of that thing just gangbusters. Prices were going up. Money was cheap, easy, everything. So everybody dove in. But here's what got missed. The need for housing was always affordable housing, but you can't really go to a bank with a pro forma and a proposal and show an affordable housing complex making sense, especially today. So what the banks wanted is mixed use, and they wanted, luxury apartment complexes, which is clearly, by the numbers, exactly what developers and real estate investors did. They did luxury, grade A apartment complexes. And today, what you're saying, I just did a whole study on this on a YouTube video, and today in the Sunbelt states, which is where you're seeing it the biggest, let's focus on Florida and Texas, vacancy rates are up as high as 17%, especially in Florida. Now, I know this, and I think your audience probably does, but when you do a pro forma, you might show a 5% vacancy factor, okay? And you show it at the current rents, and you usually show your rents escalating going up. Well, the exact opposite's happening right now. In luxury apartment complexes or grade A, what you're seeing is double-digit vacancies, which doesn't pencil. Then you're seeing rents not being able to be paid, so they're dropping rent. So you're seeing a declining rent Okay. And you're seeing a higher vacancy, which basically spells disaster. They're just barely hanging on. I'm not saying there's not a need for housing, but the need has been affordable housing. And I don't remember the numbers, and sorry, I'm not going to be able to point them out, but the sway for how many luxury apartment complexes are under development now, it's like 500,000 or maybe even 1 million versus how many affordable housing, which is like tens of thousands that are being constructed right now. They got it wrong. It was completely flipped the wrong way. If they went with the affordables, they would be sitting pretty today. But you see, in a development cycle where you get approvals and you start, like you're going verticals usually 2 years into the project. So we're into this cycle now, 3-4 years. So now all these buildings are just being built, but they're being built for a person, for a tenant that doesn't exist in today's world or is very rare. So you got to always understand, like economics is simple. You got demand, okay, and you got whatever your product is. So price has to come down to meet demand. That's the only solution. So you have to see a softening in price. You have to. It's just pure economics. You're just not seeing it now because employment rates are people are all employed. The unemployment rates are very low, which means people can still get credit. And if you look at credit card debts or you look at any debts, they're through the roof.
Dude, I love you say that. There's over $1 trillion in credit card, like revolving debt in this country. And nobody's talking about that.
Nope. Can't find it anywhere. You have to subscribe to economic newsletters to even be able to see these real numbers. They don't exist in the media.
And I tell people this and they're just like, yeah, but every time I look at the stock market, it's like up, 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 up. Regardless of what the news is, jobless claims are up. Stock market goes up, jobless claims go down, stock market goes up. The consumer price index goes up, stock market goes up. I swear to God, people just have their head buried in the sand right now. And they're still just sort of reminiscing about the party on the uptick. And I don't think anybody's looking at the data right now. And I love that you said that about the affordable housing thing, because I'm into manufactured housing communities and I also own a few hundred affordable housing apartment units. And like, we talked about this a couple of weeks ago, like inflation is the invisible tax that's vaporizing the middle class. So these people can't afford these Class A, beautiful stainless steel appliance, quartz countertops apartments at Austin. They can't afford that anymore because wages are just not keeping up. So it's an interesting take on that, Chris, for sure.
It's already a wake-up call if you're in it. But from the outside looking in, you're just not seeing it yet. But you will. But this whole thing, I've been in the financial business now 22 years. And I didn't really get into like what level, but in the registered investment advisory that I used to work for, I was deep in, like I worked with hedge fund managers in the dark pools. I saw things that I wouldn't even repeat to this day. Things that basically show the cracks in the foundation and how deep they go that nobody will ever see. But when they do go, it's game over. And it's like an '08 kind of thing. You're not going to see a pullback in housing like you did in '08, but it could be a lot worse. And I don't know where it's going to start. But if we don't get interest rates down, I know the Trump administration is trying to bring rates down, love him or hate him. That's what he's trying to do for, all this crap with Powell. It's always a charade. But if rates don't come down, what you're seeing happening is during that cheap money cycle, for any of you that are in real estate, when you take out a commercial mortgage, usually you get a rate lock for 5 or 7 years. Well, guess where we're at? 2025. Conveniently, we are 5 years in, which means, myself included, a lot of those mortgages that we had at 2.5%, 3.5%, maybe 4%, they are now doubling or more. They're going 7%, 8% in some cases. You can't stabilize that, period. I don't care if you're 100% occupied. You just can't. And that's what's happening. But we're not hearing it or seeing it yet. But next year, you will. Next year, it gets even worse because that's when the bulk of those mortgages start to come up on maturity. And what happens at maturity, you got to refinance. And that means you're going to reset it wherever rates are at that time. And right now, I just looked the other day, like high 6s, low 7s, like that's where you're going to reset. But if you're used to running your numbers at 4 and now you reset at 7 or high 6s, like you're screwed.
I think it's funny. These guys were underwriting these properties at, it'll be 4% forever. And I'm like, shit, dude, I bought my first house at 8 in 2000, like 8.5 or something.
Chris, I'm curious to where you think this goes. We've actually talked about this a bit on the show with other investors, and we've talked about it for the same reason. Money was cheap. People were locking in. It's very different than these 30-year fixed, right? Like they lock in low rates on residential, personal property, 30-year fixed, no big deal. But it's these commercial loans that are, like you say, 5 to 7 years, they have to renew. And a lot of these started in 2020, 21, 22. And those loans are coming due. And it's interesting because the banks don't want these properties back on their books, but interest rates are double what they were when they bought these properties. And so they don't pencil. And so I know that some investors, some of the larger investors that we know we've had on here, like they said the banks are willing to negotiate, but not everyone's in a position to be able to negotiate with a bank. And so I'm curious, what do you think banks are going to do when they get these properties back that they don't want on their books, but they don't pencil? Do you think they'll sell them at a discount or try to negotiate terms? What's your thought on that?
That's a great question. And it depends. It depends on, do they start reducing rates? And listen, 0.25% is not going to do anything. 0.5% is not going to do anything. We need a big drop. And the only thing that's going to create that kind of a big drop in rates is a recessionary period. So back to that, like, what do I think banks are going to do? I to be honest, I don't know. There's no systemic risk right now in the banking industry from what I can see, at least from what I can see, which means banks are healthy. They're well capitalized. They've got reserves. Like, they're in a good position. So banks could absorb some of that, right? Banks could afford to take some of that property on. And I think that they would to a certain extent. I don't think it'll be like '08 where they're literally just trying to rush to clean their balance sheet to meet the Fed's minimums. But right now, actually, the Fed, if I'm not mistaken, and I could get this wrong, they just made some changes in what the reserve requirements are, how the reserve requirements are calculated for banks, which is going to open up some liquidity, for much needed liquidity for a lot of these folks that are kind of in this gridlocked state we're in right now with banks. Banks are just taking forever. And it's not just banks. Listen, you could be a huge investor. I work with developers that are doing $100 to $500 million projects. Like, they're just gridlocked from the bond standpoint, the institutional lending standpoint, right down to the regional banks. They're all very slow to move. And I gotta believe it's because, well, listen, like, at these higher interest rates, which for us, like being a little bit older, the rates we're at today, these are kind of normal. These are like normal interest rates. I got news for a lot of you younger folks. This is the norm.
That's what I've been saying.
The norm is not what we just went through. That is an anomaly that will probably never happen in our lifetime.
2.6%, 3% interest. Like, what? Yeah.
So, like, if anyone thinks, oh, well, rates are going to come down, Trump's going to push them, he's going to fire Powell, and they're going to bring... No, it isn't going to happen. That would be more problematic than keeping rates where they're at or softening them a little. Like, the problem... I just don't know. I don't know how big of a fallout we're going to have here. And I don't think anyone does, to be honest, because like the normal housing industry is fine. That's what I mean by systemic risk. The 30-year primary home that got beat up in '08, they're fine. They'll come off their highs like they are now. But the problem is in the commercial, like in how big is the risk in the commercial space, the CMO space? It's bigger than the residential, which took down the whole world in '08.
I think the biggest difference is the banks have learned like they don't want to be in the real estate game. And that's where I think it'll get interesting. I think it'll be an opportunity for those that are ready to take that opportunity. I have a friend who he took over a project. He's an experienced investor, has a few thousand units, and they did something like 2% interest only for the first year, first 2 years, and it bumps up 1% a year. They're going, hey, here's an experienced guy that took over a backwards property, but has the skill set and experience to actually turn this around. And the bank's going, we don't want it in the condition it's in, but we're willing to negotiate because he has the skill set to be able to turn this thing around.
Yeah, I think banks are going to want good operators because there's a lot of dumbass operators. There's a lot of dumb shits that read some books, right? And then they went out and became syndicators. And there was so much stupid money out there, like you said, trillions of dollars were injected into the economy that people were just handing these idiots money. And they were underwriting these properties with the most rose-colored glasses, like the thinnest of margins, the thinnest of debt service coverage ratios. Everything's up and to the right. Rents are up and to the right. Interest rates are going to stay subdued. And I think banks are tired of dumbasses that are on Instagram cashing, their checks in front of the rented Lambo. I always say that. I love saying that. But banks want experienced operators. They want guys and girls that are looking at properties with conservatively. They're logical. They understand how to operate an asset. They know how to maintain the asset because at the end of the day, that asset is sort of the collateral behind the loan. And if you have an idiot running the asset, and they're looking for people that are going to put their own money into the deal too. I think that's something else that a lot of these guys didn't do. And
I've seen that a lot in my industry is human capital, we'll call it, like just the experience, that wisdom that people have, the operators and the good versus the bad. And I think banks or just anybody right now is willing to invest in that human capital, that good operator that has the wisdom and the know-how to do this. Because listen, as we go into this new age, which what you call it, whatever you want, the AI age, the Terminator 2 age, whatever happens. You can't stop it now. But like, people, I feel like it's just making people dumber, but it's really, all it's doing is it's leveling everything out. It's making the people that want to put the effort in, that want to continue to learn, that much more valuable. And then everybody else that doesn't, that, like you mentioned, the rented Lambos, the photos, the weekly rich shots that they do, or however you want to call it, like, they're just going to become worth less, because too many people right now put value on their time. Like, they value their hour. We've kind of gone up through this weird time where baby boomers, Gen Xers like me, we've been raised to think like the only way to success is to hustle and to work and to do all this extra stuff, which basically is trading hours for dollars. Where really, if you study the wealthy, which is primarily all I do, is look at the wealthiest families and the family offices and how all these people function, they don't operate that way. They operate on how much value they bring to the hour, not how much their hour is worth. And the other big thing, and this is what most people are missing today, is you're never going to get rich or wealthy if you just trade hours for dollars. The only way to get wealthy and stay wealthy is to understand how to make your dollars work for you. And I think that's a lost art. That's like that human capital, that operator. Like, it's not just a good operator in real estate. It's a good operator from a cash flow standpoint, a good operator that understands how to run the books and how to look at financial reports. And guys, I don't know where they teach that anymore. I really don't. It's like a lost art, because AI has taken over all that stuff. Like, now you don't need to know how to do it. All of us on here, we had to learn that the hard way. We had to learn debits and credits, spreadsheets. We had to learn it all that way. QuickBooks, when it came out, like today, you know that, like, AI is doing everything. It just feeds off their bank statement. They don't even know what a balance sheet or a profit and loss is. And if they got one in front of them, most of these kids don't even know how to read it. And I'm not trying to bash any of you younger folks. I'm trying to wake you up, because, like, literally, if you don't wake up, it's not going to be a pretty future. It's just not.
Well, you mentioned the rates, and I think a lot of people think that it's Jerome Powell. He just sits up in his office and he sets the rate. And, and as a real estate investor, I see his face, and sometimes I want to smack him. I'm just like, damn it, lower the rates, because I'm selfish, because I want rates to come down. I've got commercial properties that are refinancing. Luckily, I underwrote them crazily conservative. So I've got plenty of cash flow to cover the debt. Maybe my cash flow goes down, but I'm covering these properties. Yeah, you want to smack him when you see his face a little bit as a real estate investor. However, people forget that most interest rates are tied to the bond markets, and that's not as connected to the Fed. The Fed's the overnight rate, right? The bond markets, 5-year treasury, 10-year. I'm constantly watching those things. And it's just a weird time. Bonds have been weird. Like, in the past, if equities were up, bonds were down. People would retreat out of equities into bonds, which would lower the yields, which would lower the rates, and real estate, but now you've got like this, I don't know what the hell's happening in the equities markets. These people just keep going and going and going. But the bond markets are sticky too, because the bond market is indicative of people's confidence in the US dollar, confidence in, US treasuries. And love him or hate him, this isn't a political show, because there's certain, Trump's a real estate investor. I'm a real estate investor. I love so much of that about him. But when you jerk the wheel all over the place and you freak the world out and people flee out of the US bond, that drives yields up, and people don't understand that.
Everything that you just said is spot on. But the one thing a lot of people don't know, that maybe I do just because, being a financial advisor and understanding it, is what he's doing is brilliant, but also freaking scary, because that you just don't know where he's going to go next. It's like the art of war 2.0, right? It's exactly the game he's playing. But what it's done for bonds, specifically talking treasury bonds. And if any of you want to understand this, it's simple. You lend money to the United States government for a specific period of time. The duration could be a month, could be 30 years, right? You pick the duration and you lend it to the U.S. government. The government pays you an interest rate. They call it yield. And the price, let's just say it starts at par, let's call it $100, right? That's your level ground. So $100, you get 4% for a 30-year bond. Everybody understands after 30 years, the government will pay you all your money back. And during that 30 years, you made that yield. That's the simplest way it works, but that's not how it really works. How it really works is it's driven by lots of things like fear and everything you just said, like the dollar and everything else. So there's a lot of variables, but what Trump has done specifically, it has literally destroyed the price of bonds, driving the yield high. And when the yield is higher, it means that there's more risk. People are seeing more risk to give the government money, to lend money to the government. So they have to pay them a higher interest rate. Think private lending. That's all I do now is lend money. Like, if I see a deal that's riskier, I normally won't do it. But if I did, I'd have to get paid more. Well, the government's the same. If China or Japan views the U.S. as a riskier investment than they had in the past, the U.S. has to pay them a higher interest rate. So just understand that. So right now, yields are high. They should not be. I want to preface that. They should not be given where we're at. Yields should be significantly lower, but they're elevated. And when yields are high, it does a unique thing. Think real estate, right? Since this is a real estate show. When yields are high, price of the bonds are very low. So if you buy a 10 or a 30-year treasury bond right now, today, and this is not investment advice, I'm not giving you a recommendation, the price of those bonds is stupid cheap. I mean, like literally like go back to '08 when we were buying those real estate deals, 9, 10, 11, we were buying them stupid cheap. That's bonds today. So the opportunity in bonds is not the rate you're getting paid today. The opportunity is what happens next to the price. Well, I'll paint the picture. The economy continues to weaken. You know, when we get through this little charade, it won't probably be this year. Next year, you're going to really see it. Economy weakens. Fed starts coming off of these high interest rates, starts dropping rates. Maybe we enter a recession next year. I can't predict the future. I don't know what's going to happen, but I'd be likely thinking it would. They slash rates like they always do. That's the first lever they pull. When rates go down, guess what happens to the bonds? If we were just talking about bonds being an inverted relationship, rates go down, price must go up. You bought it, rock bottom price, the price has to go higher. But it's been this funky thing lately where you're just not getting the normal movements that you would, but it's all part of the show. That is just a massive opportunity that is being missed. And the reason I know so much of this is because I understand it, but also I work with CEOs and the chief investment officers at these giant mutually owned insurance companies that have hundreds of billions of dollars invested. And they're telling me, hey, Chris, this is what we're doing with our money. And I'm like, oh, well, I'm going to do that. What's that? I've been buying bonds for years. And, you know, a lot of people say I'm dumb for it because obviously I've been buying the cycle down because you never know. You're never going to get the bottom. You're never going to get the top. So I've just been dollar cost averaging down, down, and down. And I've got losses. And last year I harvested my loss. So I sold them all, bought them back, you know, in 90 days. And then here we go again. But yeah, I'm just waiting for this moment because those bonds will skyrocket.
So what do you do if you're a real estate investor? We got people listening. We're getting to running out of time a little bit, but you know, and I want to talk to you about your banking, infinite banking thing. But like, what do you do high level, what do you do if you're a real estate investor?
If you're a real estate investor, great advice for you. Money's key, right? Without money, you don't have a real estate business. So get really, really good at building relationships with private lenders. And I don't mean institutional. I mean like us. Get really good at people that have money and solve their problem. It's one of the universal laws, solve somebody else's problem. So I created Private Money Club. That's one of my tech companies. It's simple. The idea many years ago was, why isn't there a place like a dating site that brings people with money together with people that need money? So I did that. But the only reason I did that is in my flipping years, I got super freaking good at building relationships with private lenders, individuals that had self-directed IRAs, had money in cash value life insurance, had money just sitting around, and they didn't want to take risk in equities. So I started borrowing from them, paying them 12, 15%. They loved it. They were in a first lien position and getting 12 to 15%. That is what real estate investors need to do today. Stop getting good at going to a bank or a hard money lender. Get good at building relationships and talking to people. And I'll recite, seek and you shall find, and ask and you shall receive. Knock and the door will be opened. Knock on people's doors. Pick the phone up and say, hey, I got an opportunity that I think will solve your problem.
I love that advice. I mean, it aligns very much with all things we talk about at 0 to 100. I mean, I say it all the time. Every single real estate deal has come from a conversation or relationships. And I don't think we can overemphasize the relationship piece enough. I think there's a transactional aspect to real estate, but the relationship piece is so important and often forgotten, and people want to automate everything. But that relationship piece, and I'll say it again, every single deal has come from a conversation or relationship. So I'm glad you said that.
Yeah, you can't automate the relationship. So that's what all your followers and everybody watching this should get good at, is relationships, but build relationships around people that can lend you money, because then when everybody else's money dries up, guess what you got? A loaded gun, and that gun is just your bank account.
Yeah, I love that. And I don't think AI is going to replace relationships. Maybe in certain industries I won't bring up, but for the most part, I don't think AI is not going to replace relationships. I think it's really important. And you're right, when the money supplies dry up, people are in trouble. There's going to be some assets for sale for really cheap. And like you said, if you've got dry powder or access to dry powder with people and you can solve their problems, I think you're going to be in a really good spot. We have 2 questions left for you, Chris. I'll take this one, and then Gabe, I'll let you take the last one. Define infinite banking. I was watching your YouTube video. You're talking about infinite banking. Help us understand that.
Yeah, infinite banking concepts is a process, and it's a process that allows anyone to take back the banking functions in their life. And what I mean by that is most of us have been taught to utilize banks, utilize credit, and every payment we make on our debts goes to someone else's bank. The infinite banking concept is changing one thing, and that's where your money goes first, and then adding one step, which is a process of how you use your money, and you literally just mimic a bank. I'll give you an example. Like if you got a credit card that's 20%, and you then changed where your savings went. You put it into a specially designed whole life. And I'm going to tell you that's what the machine is, specially designed whole life insurance policy. And then you immediately took money from that whole life as a loan from the insurance company and you paid off the credit card. So think of a circle. The money starts on the left in this whole life, which most of your audience can be like, oh my God, that's the dumbest advice I've ever heard. Stay with me. You got it in this policy. Now what we're going to do is we're going to take a loan from the insurance company. And as long as it's designed properly with the right mutually owned insurance company, they will allow you to use their general account. So you literally are borrowing not from your account. So if you've got 10 grand in your policy's cash value and you need 10 grand to pay off this credit card, great. You take money from the insurance company's general account as a loan. They give it to you, no questions, not like a bank. They literally are giving you part of your death benefit. So the insurance company does this because they promise to pay a death benefit when you die. So if they give you 10 grand, that's 10 grand off of your death benefit you get to use today. You pay the credit card off. Now, right there's one thing I want to preface. In the infinite banking concept, the reason why it works is your money, your 10 grand is still earning guaranteed interest plus dividends in a tax-free environment. It is compounding. We all know compounding. It's a very powerful thing in the financial world. So if you're compounding it, let's just say 6% dividend crediting rate. That 6% on 10 grand is going to continue to grow while you got 10 grand to use to pay off the credit card. This is the part that everybody seems to miss in the infinite banking. That's not the reason you do this. The policy will never make you rich. I want to preface that. You'll never get rich from the policy. The policy will just allow you to earn a spread on your money. Because if you're making 6 and you're paying the insurance company 5, you're making a spread. But now if I use the money to pay off a 20% credit card and I take the exact same payment I was given the credit card, let's just say it was $100 a month. Okay, I was paying on that $10,000 credit card at 20%. And I take that $100 and I change the name on the check. It no longer says Visa. It says Chris Naugle. And I pay that back through a bill pay to my policy. Now, here's what's happened. I now have $100 every single month in cash value to use the very next day. So I lost no liquidity of my money and I'm in full control of that 100. Unlike before, that 100 left me and I wasn't in control of it. But now I made a spread. I literally made money twice on the same dollar. I made money on the spread between the interest rate the insurance company pays me and what they charge me for my capital, the policy loan. But now I also made a spread over on this side because I was paying Visa 20 and I'm only paying the insurance company 5. So I'm making money twice on the same dollar, all the while having all my money available to be used, not losing any liquidity of my money, and allowing my money to compound uninterrupted. So that's the infinite banking concept. Again, taking back the banking functions in your life.
Chris, I know we could spend an entire probably hour or more just on the infinite banking system. We are up against the clock, so I do want to ask you the final question that we asked all of our guests. If you were to, this is a hypothetical, if you were to lose it all tomorrow and you're sitting on the curb with your buddy also lost it all, so he's not much help. What's the first thing you do? You have no money, you have no assets, and you actually don't have your network either, but you have your knowledge. What's the first thing you do?
The first thing I would do is sit on that curb with my friend, and I would, for the first time in a long time, stop and just become aware of my surroundings and everybody around it. And I'd be looking for somebody that I could solve a problem for. Maybe it's an old lady that needs help carrying groceries. Maybe it's somebody that just needs us to laugh, to smile. That'd be the very first thing I would do because I've learned something in my 48 years that is more powerful than anything else I've ever learned. And that is the secret to success is solving somebody else's problem. And it can be the simplest thing. So I'd start there. Now, once I did that, I have some time with that person because now I'm helping them. So now they're willing to, have a discussion. I'm sure that's not the only problem I have. Because of my knowledge, I can get into a basic conversation and uncover some opportunities. The longer I sit on that curb, being aware of my surroundings, looking to solve somebody else's problem, I then will uncover opportunities, which will allow the knowledge that I've accumulated in 48 years to be put to work. But it all started with that number one thing, and that is solving somebody else's problem, not mine.
I love that you said that. I mean, the bigger the problem you solve, the more money you make. I mean, you look at Elon Musk, the guy solving interplanetary problems, right? And he's always been a huge thinker. And again, the larger the problems you solve, the more wealth you grow. So love that answer, man. Chris, it's been awesome having you on the show today. I think that we've covered a lot. I would love to have you back on someday. This has been really interesting. I love we talked about business, we talked about real estate, we talked about mindset, which is something a lot of people, I think, overlook when it comes to building wealth. So just really appreciate your time, man.
Yeah. Thank you, Chris.
I guess last question, how do people find you? Because I want to we'll put this in the show notes as well.
Yeah, I'm everywhere. Just go any social media site and type in @the Chris Naugle, Naugle, and it won't be hard to find me.
Love it. And look forward to meeting you in person someday, my friend.
Looking forward to it.